All right, now we're going to spend some time talking about patterns. This is our Introduction to Patterns module. And if you don't know what patterns are, there are wonderfully beautiful configurations of price action that are really visually appealing and easy to recognize and often can result in fantastic trade opportunities. It's one of my favorite ways to trade. And really what they are collections of price action that are confined by support and resistance. And what's very cool and very important is that they represent market psychology. There's a lot more psychology coming into play in these patterns than in the random noise that you get that often precedes that during price discovery. So they are, in short, confined areas of trading ranges. They are influenced by market psychology. Just like trends are fractal and repetitive, you can have pennants inside pennants inside pennants. And what is absolutely wonderful about these guys is they provide clear, actionable signals and give you clear levels for breakouts. And there are a lot of trading opportunities to be had utilizing patterns. So before we start using patterns for trading, we really need to recognize how fundamentally important they are due to the fact that they are driven by market psychology. Patterns follow explosive price action. So when you're in a period of price discovery where it's just noise and chaos essentially, you see how quickly the price has moved in this example. After a big breakout, we know that trends like this are unsustainable. So we need periods of consolidation where those prices can come down, relax a little bit. The market can come to terms with what just happened. And that is what we see in a sort of a breakout into a pennant formation like this. A monster breakout, we see some lows, we get lower highs and higher lows, a tightening range comes, and then we get a breakout. So these patterns often follow price action and explosive movements, so we can look for consolidation patterns and keep an eye out for those developing and the trading opportunities that comes with those. But we need to recognize that it's human behavior that's driving these patterns. The psychology of the trader, as they watch and as they wait for further opportunities to arise, these are how these sort of patterns develop. Now, algorithms who do a lot of trading for different firms or hedge funds or what have you, they mirror these concepts. So even if the market is predominantly run by algorithmic trading, this algorithmic trading has been designed to mimic and capitalize on the market psychology of retail human traders. So they work together in tandem to reedify and to make these patterns real and abundant. So algorithms mimic human behavior, and ultimately it becomes a battle of supply and demand as these patterns converge, as this price action gets more and more contained, and eventually you have a breakout. It's key to remember, though, that human behavior is imperfect. People often recognize patterns where there are none, and patterns can and do fail. They are not perfect. We need to be vigilant just as we are with trends or any other type of trading. We need to have a plan, and we need to be able to capitalize on that plan, but also be responsive and open to adjustment and open to pivoting our targets and our trajectories and our entries. All right, let's talk about some issues that people have with patterns. And just like with trends, there are issues with using patterns. And we need to be conscious of these issues so that we can mitigate the risk that comes along with them and allow ourselves to make good quality trades based on good data, and while being aware of the potential weaknesses that we have, because we are flawed human beings and we make mistakes. So let's talk about some of these issues that I see happening time and time again with patterns. And the first of those is that people find patterns where none exist. It is incredibly common for students to send charts over to me for validation, and they're asking, is this a nice descending wedge? Did I draw everything properly? And a lot of times the wedge itself is not so bad, but they're incorporating incorrect data. They're going too far back into history, and they are taking things that happen to work out, trend lines that happen to match up, and they're saying, yes, this is all part of the same pattern. But patterns are created between periods of price discovery. You have a massive move, you have consolidation in the form of a pattern, and then you get ready for another move. A lot of students connect these areas of price discovery when they should not be connected. And that really just says that people find patterns where they don't exist. And we need to be conscious of the fact that we may be incorporating incorrect data that does not belong in our pattern, and we need to watch out for that to make sure it doesn't influence the way that we read the market. The second issue is people make decisions based on coincidence. And that's sort of what's happening when you're tying these different data sets together, these areas of price discovery. Just because you happen to have a trend line that lines up 3-4 times does not necessarily mean that it is a solid trend line and we need to be relying upon it. We need to have a trend line prove itself in the moment, in its particular context, for it to be valuable. People make decisions based on coincidence, patterns happening to line up just ever so slightly and reifying their own ideas. Again, that flows into our next issue. Humans are biased toward thinking about their own goals. If you're looking at gold, you're a solid gold trader, you're looking for upside continuation, and you just have that inherent bias with you, you are going to be looking for things that match that bias. You're going to be looking for patterns that go to the upside. You're going to ignore signs of a potential downside action. You're going to ignore weakness. You're going to focus on things that really match your own bias, your own goals. And in turn, you're going to make decisions based on coincidence and probably find things, make patterns where none exist. Another issue that we have with patterns in particular is that we expect history to repeat itself exactly. If you've looked at 15 bull flags and 15 bull flags have worked out excellently, all giving profitable moves to the upside, you're going to expect that next bull flag to do the same thing. However, we know that we're trading, we know that patterns can break in any direction, and we know we have no control over the price, so it's just as likely that a bull flag is going to break down as it is to break up. So we need to be conscious of the fact that just because things have happened before doesn't necessarily mean that they're going to happen again. The odds may be in the favor of an upside break, but it doesn't necessarily mean it's actually going to happen. Lastly, we place a lot more emphasis on recent events. Let's look at that bull flag example. We have 15, and let's say 13 of those have worked out poorly. They have all failed. And the last two worked out perfectly. They broke to the upside. We're going to place a lot more emphasis on those recent events than we are in the previous 13 events. And that's just because what happens in our recent memory is so much more vivid for us. It's visceral, and we rely upon that information, and we tend to forget about things that have happened in the past. We focus on the now, and if the now matches our bias and it matches the decisions that we're making based on coincidence, and maybe even matches these patterns that don't exist. If all of these things work in tandem, it can result in us making a lot of bad trading decisions that we could have otherwise avoided if we were conscious of our different types of biases. And these biases are really well represented on the bottom of our slide here. We've got a few different ones we can talk about, and they're going to sound familiar because this is exactly what we just went through. First of all, we find patterns and noise. The stock market is primarily just financial noise data, completely random and only punctuated by periods of psychology-based trading or algorithms that are mirroring psychology-based trading. And it's these brief moments that we can capitalize on through technical analysis. So we tend to find patterns in noise. We find patterns where none exist. The other bias that we have to worry about is the bandwagon effect. If you have an idea and you're not super confident on it, but you share it anyway, your friend might take a look at it and say, yeah, this matches what I think. And he'll share it and they'll share it and she'll share it. Eventually you end up with a group of individuals that all are sharing the same idea. They're talking about it. They're positive. They're excited. And it makes its way back to you. And your little idea, that seed of a concept that you have, is now being reinforced by the countless millions of faces online. You're going to jump into what's called the bandwagon effect. You have made everyone excited. They're making everyone excited. And that's that positivity feedback loop that we mentioned earlier in the course. Another thing we need to be conscious of is the confirmation bias. You're going to be looking for things that match what you expect to happen. If you think that Tesla is going to move to the upside, you will focus on finding indicators and elements and people who confirm what you already suspect to be true. You will ignore contrary indicators. You will ignore people who are naysaying, and you will focus primarily on what you believe is going to happen. It's a confirmation bias. Another bias we need to be conscious of is the hindsight bias. The hindsight bias basically has you looking at historical events and then using that information to look at your own current event and saying, yeah, I knew exactly what was going to happen. All of these other times I knew what was going to happen. This time I knew what was going to happen. Next time I'm going to be confident because I know that history is going to repeat itself. Sound familiar? And I will make a correct decision. Hindsight's 20/20. I know everything I need to know. I'm going to make good decisions from now on. And that can be incredibly dangerous. No one knows it all along. If someone tells you that they knew it all along, especially in the stock market, they have no idea what they're doing. We are simply reacting to conditions that are present. I have no idea what is going to happen moment to moment. All I can do is wait for that data to come to me, make a rational decision based on the information I have provided, and hope that I am making it in the right direction. And knowing that if I make a mistake, I've already established a plan to mitigate my risk and my loss, and I'll move on to the next trade. That's what technical analysis does for us. The last thing we want to talk about is the positivity effect. And this really means that we are going to be confirming and focusing on things that have happened to us that are good. If you are excited about 5 bull flags that have broken to the upside for you, and you are going to ignore 20 that have failed, that's the positivity effect in action. We remember the good times, we ignore or repress the bad times, and eventually all we end up with is a situation where you're feeling good. You believe you've known all along that bull flags break to the upside. All the indicators seem to match what you're thinking. Everyone else is saying, yes, this is a good trade, and you've already found this pattern that may not necessarily exist. All of these things work together, work in tandem, and they get us excited about a potential mistake. So when we're trading patterns, we need to be aware that all of this happens all of the time, and we need to be conscious of the fact that humans are flawed creatures. We can use technical analysis, but ultimately it relies on us being aware of ourselves and making decisions while being conscious of our flaws.